Thank you guys for joining us. For those who don't know me, my name is Morgan Krupetsky. I lead on-chain finance business development at Avalabs, which is one of the core contributors to the Avalanche blockchain network. And today we're going to be diving into programmable private credit. What does that mean? We're going to talk about that. We're going to talk about how the Avalanche ecosystem is really helping to move forward this space with both tech as well as with capital partners. Private credit and programmability really get thrown a lot in the RWA. They get thrown around a lot in the RWA space, but I really want to use this time to really kind of break this down. What are the real pain points that originators are dealing with today on the operational side, and how can the Web3 tech stack really fix those problems in practice? A lot of the conversation in on-chain finance to date has really focused on, and the last panel I think was an example, of bringing TradFi assets into crypto. And what we're going to explore instead is how on-chain finance can actually upgrade the way TradFi operates by improving infrastructure and workflows for banks, asset managers, new funds, and fintech originators. So to that end, I'm thrilled to have Avalanche partners here today that are really at the forefront of driving this forward. And they really span the full kind of private credit lifecycle. So from the origination side, we have Mike Barbosa, CEO of OatFi, which we'll get into shortly. From the investor side, we have Connor Dougherty, representing Valinor. And then in the middle, literally in the middle, at the Apple layer, we have Juan Montero, CEO of Fence Finance. So just to set the stage and to level set for the audience who may have kind of varying degrees of expertise and knowledge of the private credit space, Mike, let's start with you. If you could tell us in simple terms, as simple as you can, what is OatFi? What do you guys do? What is your business model? Let's kind of start there and then we'll dive in.
Sure. And thank you so much to Avalanche for having me, and extremely excited about this partnership. OatFi is the modern credit network for B2B payments. What that fundamentally means is we provide the end-to-end infrastructure plus capital for any accounts payable, accounts receivable, spend and expense management platform, anywhere a business is sending an invoice and or making payment, to embed what we think of as the table stakes working capital needed to shift what is really this paradigm shift in offline B2B payments coming online. So whether it's a net term solution that enables a business customer additional days to pay, extending their days payable outstanding, a net term solution or early pay solution similar to traditional supply chain finance, trade finance products that shortens the DSO, days sales outstanding for business suppliers when selling to business customers. We embed our ability to underwrite, originate, and fund these very short-term working capital commercial credit assets directly within the accounts payable, accounts receivable platforms that we work with.
So nothing to do with crypto, nothing to do with stablecoins.
Not yet.
Not yet. Well, we'll get into that. So as it relates to kind of like how your business operates today, obviously you're in the trenches every day with respect to financial workflows, managing working capital, especially in the context of you addressing very short-term capital needs. I imagine that becomes much more kind of relevant. What are the biggest headaches or kind of roadblocks that you guys feel like you are faced with every day that you run into when you operate on what we call traditional rails, but in finance today?
Sure. Yeah, I would say at the ground level, we are essentially running three different businesses. We run our own product strategy that defines how we actually build our APIs that connect into our infrastructure, how we support that infrastructure. We are running a risk management business where we are exercising our opinion on the underlying obligors and the receivables that we're looking to execute against, or I should say originate for those underlying obligors that then creates this exposure for us. And then of course, we're running a capital markets business where we're interfacing with a number of banks, private credit funds, warehouse partners, forward flow partners that enable us to actually move money across our rails and facilitate these transactions between businesses. Operationally...
Where does it get annoying?
Yeah, operationally, the last is very, very hard. I think given the very short-term nature of our book, the functional flows between ourselves and our warehouse partners can create a lot of operational friction. So just to walk you through how a transaction or how money actually flows through OatFi. If we choose to originate a transaction with the commercial end user of a payables or receivables platform we're working with, we are either originating the purchase of an invoice receivable, originating a loan and servicing the draw against that loan. We may send money out on day one, but we're not able to actually get the funds that provide OatFi itself leverage against that receivable that we originated for maybe 3 to 7 days. Given the extremely short duration nature of our book, that can cause a lot of operational challenges when we send money out on day one and we can't get money back until day 5, 7, sometimes even 10. And so given that, we get to work with folks like Valinor and Fence to hopefully shorten that time that it takes to actually receive money on the front end. Beyond that, a lot of the assets that we originate are extremely short duration. So think about a case where we may be originating a 5 to 7 day receivable. In the case that we can't actually get that money from one of our warehouse partners operating on traditional rails for 5 to 7 days, that creates a cash flow problem, a working capital problem for OatFi itself, given we're unable to get that leverage, in time.
And Connor, I know before starting Valinor, you worked at a more traditional fund, Blackstone. Curious kind of from your perspective and experience there, if you could kind of provide the perspective from the investor, the lender side, what did some of those like operational kind of issues or frictions look like from your side of the equation? Obviously, a lot of firms like Blackstone, Apollo, and others have ginormous middle and back office teams to actually deal with a lot of this, but curious kind of from your perspective what that looked like.
Yeah, asset-backed finance, these revolving credit facilities, they're much more operationally intensive than just a traditional loan. And that's because they're referencing underlying collateral, in this case receivables, and so there's a lot of monitoring of that collateral and verification of that collateral that goes into it, but that's a spreadsheet-based process. And so what that really results in is on both sides, both the OatFi side and collating that data, and then the back office side of the private credit firm reviewing that data. That's a multi-day sequence typically, and so that's before you get into the slowness of the money movement of the traditional rails. And so if you play that out, that means there's a handful of very large private credit firms that participate in this market because they have that back office infrastructure. That's a high barrier to entry market, even though the risk reward is often very attractive, especially in these shorter duration assets. And so a firm like ours likely wouldn't be able to participate in this market at all. Yes, like Valinor, unless we were using these newer tech primitives. And if you play that out even further, that means there's going to be a lot more firms and a lot more participation in the market, which is good for a firm like OatFi because they have a more robust capital offering. And so you'll see a lot of, I think, both TAM expansion and entrepreneurship in this market because of the tech.
Is there anything, Juan, you would add? I know from a Fence perspective, you speak with obviously both sides of the equation and have worked with banks like BBVA and others. Curious if there's anything you would add in terms of kind of challenges or frictions that you feel like, I mean, we'll talk about how Fence is addressing them, but anything to add from a friction side of things?
I would just say that it's fundamentally it's a trust issue in some way, right? A problem where there's one originator, and this applies not only to fintech lenders like OatFi, but to the broader market, and you get all the way up to mortgages and these kind of assets. So it's basically there's investors that want to know that the assets that they are financing are the ones that they agreed to, that they are performing correctly, and then that they are getting the money back as it was stated, right? Like if they are senior before the rest of the capital. And trust is actually something that it's kind of the flagship of solving or of the problem that is solved with smart contracts. So here we are like to solve it basically.
Okay, good segue to how are we fixing this and addressing these issues? Maybe let's start with you, Juan, from a Fed's perspective, if you want to talk a little bit about what Fence is and maybe how it's kind of helping to upgrade these flows.
Yeah, Fence is basically their administration platform, or what we call a tech-native facility agent. So it's replacing or aggregating all the traditional trust and agency service providers that have been historically intermediaries that are very fragmented, using very manual processes, spreadsheets, PDF, and emails. And there's been very inefficient and specifically very slow on the money flows. As Mike was saying, it takes weeks in some of the cases to fund one specific asset, and in some of the cases it's shorter than that. And what we do basically is we encode all the rules of the game, all the covenants, all the cash waterfall, how the flow of funds should be, into a mix of off-chain technology and smart contracts. And we automate all the reporting, all the monitoring of the portfolio, and most importantly, all the cash flows between investors from different tranches and borrowers or asset originators. The big important part here is that we make it possible to basically fund assets in real time, fund and monitor the assets' performance in real time, versus what would have been like the traditional way of doing things, or the legacy way of doing things, that it's every week, every 15 days, or every month, which leads to these financial inefficiencies. And in some of the cases, for our clients, is up to 30 or 40% of the total cost of capital. So in the millions, depending on the size of the facility.
And to that, and maybe, Con, I feel like we've been talking to Mike. Actually, the first time we met was this conference last year. So we've been chatting for a while. And I remember when we kind of eventually made the pitch, we weren't pitching better infrastructure or more efficient infrastructure. It was effectively, do you want better money? So if you could talk a little bit about like what does that mean in the context of a lender and lender leveraging Fence to offer a credit facility to someone like OatFi?
Yeah, I think it means we found a good use case, right?
True.
Mike laid out his business problems pretty clearly, and that supply side, that capital market side of where he's trying to kind of borrow balance sheet or borrow, like capital from the capital markets is a really challenging endeavor. And so when you go to a borrower like Mike and you tell me, but I don't think it really resonates to be like, hey, we have this awesome tech solution. Actually, Mike has built a pretty amazing tech solution. What you should say is, I know one of your pain points and I want to work with you to address it. And I think that is a much better motion than going into, traditional financial firms and fintech originators like Mike and saying, here's a better tech moat. I think it's a better, go to market.
Yeah. And digging in a little bit to that, when we say better money, what do we mean?
Well, we laid it out a little bit, but it's not cheaper money. It's using these the new operational rails to get him money faster and time match really the money that he puts out, right, as best as we can, because the drag on his business is he's bridging that with his own equity dollars, right? And that has a different cost of capital profile than credit dollars that he's borrowing. And so if you think about the margin impact from being able to time match money that you put out with money that you borrow better, that's a big impact on his P&L as a lending business.
As well as our ability to grow, especially with a book that turns so fast.
Yeah.
It's really hard to get leverage on super short turning assets. And as that portion of the book grows, as Connor mentioned, I don't want to be funding that with equity dollars, and I don't want to be forced to raise equity dollars in the future at a much, much higher cost of capital if there is leverage available from capital markets that should like these very quick turning assets, because on a risk-adjusted basis, they perform very, very well.
Yeah, that's a good point. What's interesting is some of the best performing assets are the short duration assets, and without this technology, they're not being financed. And so we're actually getting better risk-adjusted exposure by using the tech and getting access to the assets that are probably under leveraged right now.
Yeah, and I do want to come back to and talk about kind of how you guys are therefore able to compete in this space from a private credit investor perspective. But before we go in there, I remember, Mike, when we brought Juan and the team in to kind of deep dive a little bit more with your tech team or with your capital markets team, and they were just like amazed how they don't have to spend half a day every week reconciling Excel sheets with the terms of the credit facility, and how they can kind of draw down from the facility on a daily basis as opposed to a weekly basis. Tell us a little bit more, just like anecdotally, kind of what you guys have found in digging a little bit more in with Fence.
Sure. Yeah, I would say so. Connor and I were just talking about the movement of money and the importance of having access to liquidity exactly when you need it, and changing what could be a 5, 7, sometimes 10-day process to real time, which is very important when you're talking about a 7-day asset. If you're getting money to fund a 7-day asset in 10 days, the reality is you didn't get the money to fund or to finance that asset that you had already funded off your balance sheet. Operationally, managing these flows is quite cumbersome. So we, of course, have our own very robust ledger that lives under what's called a loan management system that we maintain ourselves. We built ourselves. It manages the life cycle of all of these assets that we're originating and set accounts through their life cycle. Getting that data into the hands of our lenders is quite cumbersome. And being able to move what is this operational process of sharing that data. And yes, some folks are doing it with spreadsheets. Some folks have built software that automates the creation of a borrowing base, submission of the borrowing base. The borrowing base, by the way, for those who don't know, is just the collection of the assets you're looking to finance, the request to draw against that borrowing base, and then recycle cash that has been paid out or paid back to you on assets that you already originated and financed. Even if not done with spreadsheets, but done with some software, it is inevitably still very cumbersome. There are a number of players in the market that call themselves the software operating system for capital markets. I really hope none of them are in the room right now. And the candid or transparently, the fact of the matter is their software does not work perfectly, or rarely does it work perfectly. And I'm sure if there are other folks that sit on capital markets desks in here, they can probably attest to that. And naturally, they end up diving in and unbundling the rubber band ball that sometimes creates. And so being able to move all of this on chain and move the execution of said draw request, recycling request, feeding our loan tape to Fence that then executes this on chain, turns it from a somewhat clunky software with human in the loop process to immediate. And so naturally, again, just to take this all back, before we were talking about the speed of money or the importance of speed to access liquidity when the timing is right. But the antiquated processes that live above that coordinate these 5 to 7, sometimes 10-day workflows, moving that on chain is a win for us all, both from a timing and operational cost, OpEx perspective.
Yeah, and I think here, like the important part is that you have all the information flows, right? Like as Mike said, like there is people trying to do that. It's done with the spreadsheets. But what the smart contracts and stablecoins and blockchain brings here is being able to act on those informational flows, right? Being able to know that everything is still going as was expected and release the cash without doing this manual process and then doing a manual transfer, right? This is the big change that smart contracts and blockchain is bringing. And it's not exclusively because of smart contracts, but it's the critical piece that makes it possible to then automate and then have a bigger impact by moving the capital instantly and providing it to originators.
I think one important point, because Mike is, he's built a tech native business. Like he's at the forefront of a lot of this stuff, but he can't move ahead. What we're talking about is really an investor led motion. Mm-hmm. He can't move ahead of his borrowers and demand that they use a different process, right? So I think we're starting to hit this inflection point where I think we're going to start seeing institutions start to do a little bit more with these flows. But I think that's another important point to make, and one obviously at Valinor we're trying to lead the way with.
Yeah, and I think like we're not necessarily talking in this context about like tokenizing loans and trading them on the secondary market. Like it's very much using the Web3 stack, being blockchain tokenization, smart contracts, stable coins, to really help to operationalize, in this case, Mike's business much more efficiently in a way that, you kind of alluded to this, Connor, that it's like abstracted away from ultimately the end borrower, which is kind of, really cool to see. One question that I had for you, Connor, and guys, feel free to add in, is we were talking earlier about how the private credit space today is really dominated by, like, let's say the highest, the largest 10 to 15, private credit managers, and a lot of which is because they have the operational backbone to actually kind of compete in the space. From Valinor's perspective, which I would call like an emerging manager, I'm curious, like, tell us a little bit more about now how you are able to compete. And I think it talks about a lot of what we were touching on just now. But it's interesting because this is very much like the democratization of finance, but very much from like an institutional investor's perspective. So tell us a little bit more about that.
Yeah, I mean, I think I'd be remiss not to say, like, you still have to underwrite. It's still same risk decisions, right? And so we're talking about efficiencies here, but that process doesn't change,
It doesn't
right?
take care of the due diligence.
Like, just because you can do things more readily and easily doesn't change the fact that you need to make, I think, really sometimes challenging risk decisions. But what it does allow us to do is, I think, participate in a market with, I'm pretty proud of what we've done. We're quite a small and lean team, and participate in a market where, we're actually, our operational terms are better than what exists in the market today. So it's not really like compete. And I don't really view it in that way. I view it as, okay, he has a capital markets problem that he's trying to work through every day, and here's a solution that I can provide. And I don't really want to be on the same playing field as some of the big private credit firms, because that's not what we're trying to do. We could be additive to them. We could work with them. We're really borrower focused and looking for good risk-adjusted return opportunities. But I think we add a different value proposition. They obviously have scale, and I don't want to knock that. They can do a lot for OatFi, and so I think it allows us to participate in a market, but we're definitely not trying to go head-to-head with those firms at all. We'd much rather prefer to work with them.
Yeah, and to that end, Juan, I know you've obviously been working with a ton of different institutions on both sides of the equation, and in fact, I think have helped some win clients because of them leveraging Fence. If you could just tell us a little bit more about what that looks like.
Yeah, we have found deals that were very competitive, right? Like there was an asset originator like OatFi, and there were different lenders trying to get the deal, basically, to get to fund them. To the point of Mike, the short-term receivables were great, but there was a challenge and inefficiencies that come around not being able to fund them immediately, right? So in one case, for example, there has been several, but we were working with BBVA, the European bank, and they were able to basically provide, without lowering the cost of capital, the actual interest rate, as Connor was pointing out before, make a more compelling proposition, a more compelling total result that made it possible for the originator. It was an earned wage access company to get down the total cost of funding by 30-40%, and that was still risk adjusted was even better for BBVA than for the competitor, but the competitor just wasn't able, because they didn't have these capabilities to actually provide the same kind of service or the same kind of product.
Yeah, one thing I want to say, Mike, you tell me, but if you play this out, I think this is very positive sum, TAM expansion moment. I think Mike and a company like OatFi is going to be able to grow much faster, like he said, and he's going to have a variety of lenders, right? He's going to have an allocation ability that he didn't have before, and I think it's additive if you play this out. And I think this technology is just going to be, there's more investors, more participants, and businesses like OatFi are going to thrive. So. Which probably will reduce the cost of, the direct cost of the money to someone like OatFi, because they have very good quality assets, and now they can be accessed by a lot more investors, a bigger amount of capital, basically.
Yeah, I agree with you. I mean, I think to your point, I think in the first instance, you don't necessarily have to engineer or offer a lower cost of capital, but I think over time there will be more and more participants that enter the space that naturally it might kind of come down and...
It's a more efficient market.
Correct.
Yeah, exactly.
So to that end, we have less than a minute left. To the extent that, let's say, there's some still skeptical people and private credit investors or firms out there, in one sentence, what would you say to them in terms of enticing them to come into this space, really on the liquidity provisioning side of things?
I would want to
as if this was not convincing enough, obviously.
A polemic one. You will be out of business in some years, and I think the reason is basically you're showing up to a race with a horse, or riding a horse, then the rest of the competitors might be using a car, right? If you are using better technology, if you are using, you're having real-time risk monitoring and risk management, and and you have lower operational costs to Valinor's point. Like you cannot compete with that if you are still using a spreadsheet, like sending an email every 2 weeks or things like that. So you're winning less deals and you're having like a lower or a worse risk return proportion.
So don't show up to the race with a horse.
Yes, exactly.
I like that. I think that's a good takeaway. Yeah. Cool. Well, thank you guys for joining us. Thank you for listening in.
Thanks,
and if you guys have any questions, obviously, you know where to find us. We'll be around the conference after.
Thank you.
Thank you.